Hello, everyone. I will be trying to help you through this course, and one of the things I would like to do to help you get through is to spend a few minutes talking about some of the highlights of each one of the chapters that you'll be covering, and also interjecting some helpful hints that will get you through. As you know, this course is extremely filled with lots of information, and it might become overwhelming. My hope here is to be a guide to help you through, to allow you to ask the questions, and also direct your attention to some of the most fundamental concepts that will carry you through the course. And for many of you who choose to go further in accounting, to provide a basis upon which you will lay this foundation of accounting. Accounting is a very, very important topic in business because every aspect of business is affected by accounting. So it is a good idea to have an understanding of accounting and how to use it to make some very, very practical business decisions. Business, we all know about business. We have number of businesses that we interact with daily for purchasing of goods and supplies, um, for purchasing of different types of items like food, clothing, and we engage in it also to buy cars and other types of things. So businesses come together, and with their resources, they will process and provide goods to you and me, outputs in that case. So the reason why businesses are in place is to earn a profit. And profit is going to be what you receive from your customers in revenues or income, and what you pay out to provide those goods or services, what we call expenses. So profit is going to be the difference between services rendered or revenues versus and subtracting out what you have to spend in services that you will provide those for services that you'll need to actually engage in that process. So your expenses. So profit is going to be revenues minus expenses. Now, what is accounting and what's its role? Accounting allows us to make business decisions. It analyzes transactions, prepares various different reports for the sole purpose of allowing users to make decisions. It gives us the financial position of an organization. So accounting is a very, very important topic. You will notice in this particular course there are so many different types of terms that you'll need to understand. My hope then is to help you navigate through these different terms and concepts, and how to teach you through practice how to apply those concepts. Accounting has various different types of areas or specialties. Managerial accounting is one. Managerial accounting is really for the purpose of allowing internal users to make decisions. Internal users are like managers, investors inside the company want to make decisions. So managerial accounting is very important because they want to make some important decisions about what to produce, how to price, and so forth. And there are also private accounting. Financial accounting is important, which you will be working with is going to be for external users, mostly investors, creditors, companies like vendors, and government. Financial accounting is relevant because it will allow them to make decisions, and these are individuals who are outside the business. They are external users. Another term that you'll need to know is, what is a general purpose financial statement? Well, financial statements are going to be statements that provide you or the user information on what's happening within the business. And these general purpose financial statements are going to be used for a wide purpose, a wide range of uses. And they include the balance sheet, the income statement, and the statement of owner's equity. So the main point about accounting, and over the years we've really refined this, accountants have a very important role in an organization. And it's important that they're honest, that they do what's right, that they help people, and that they guide them to making the right decisions, not manipulate them to making their own decisions, but they want them to act in a way that's honest, that's trustworthy. So we need to make certain that we not only know our role, but we are protective and we want to do the right thing. But there are also laws that are in place for financial accounting, particularly in companies, will require some type of oversight to ensure that companies and their accountants provide correct and accurate information to the public so that they can make the right decision. There are so many things that accountants can do. This particular field of study is not only broad, but it's extremely deep. There's so many different types of positions. Right now, I'm a CPA by trade, and I work in government, and I work for the public. So it is important that I do what's right, and also that um, I comply, that I can ensure that people who are relying on me for information can trust the information that I provide. But there are so many opportunities. You do not have to be a CPA to practice in public accounting or in private accounting. Um, but just so you know, if you were to think about exploring opportunities, know that you have so many hundreds of opportunities within this field that you can get involved in. Financial accounting in the United States is governed by the GAAP, and GAAP is really standards. What we do, why we do it, how we do it. Essentially, those are the questions that basically GAAP answers. And when you're working on your assignments, that's what we're teaching you inherently. What accounting is and how it is performed really rests on GAAP. And we are talking about for financial accounting. This does not apply to governments, however. And we have, again, the FASB is going to be the developing these principles. Oversight will be the SEC. But again, the bottom line is we have these principles. They are in place. We have oversight bodies to ensure the continuity and the consistency of accounting principles across industries so that people can rely on them. So information that we provide for financial purposes has to be relevant. It has to have some way to help individuals make decisions. And it has to be honest. It has to faithfully represent the information within that organization, that financial information in that organization. We have to assume that we're going to be dealing with money, in this case US dollars. We have to assume a time period. A time period, it could be 12 months, consecutive 12 months. It could be a quarterly, but it has to be based on assumption of time. It has to be specific to time. We have to assume a business entity, again, an organization operating for the purposes of earning a profit. And it has to be relied upon that's going to be around for a while, a going concern. This organization is going to be around. It has a purpose and it will be in operation, and you can rely on that. So we have to make certain these are our assumptions. So we're going to use the currency. In this course, and possibly in your future, you'll be using a monetary basis of US dollars. And when organizations provide financial information, US organizations, is going to be measured in US dollars. Time, again, we want to make certain that the financial condition is reported periodically, whether it be once a year or once a quarter, but it has to be consistent. Time is going to be generally a 12-month consecutive period of time. Now, the business is on its own. We need to make certain that it's clear that a business entity it's all on its own. It's a separate entity all by itself, and it is not viewed in light of its creditors or its owners or any other business. It's on its own. Now, the reports, it's just making certain that you know that this company will be around. It's not going to go under. That you can rely on it to continue to provide services or to the public. Now, the principles that are important that you need to know is measurement, historical cost, revenue recognition, expense recognition. What does that mean, really? We want to make certain that you can verify the information, that it can be verified, that it is independent based on unbiased evidence. Arm's length transactions, meaning you and I have a transaction, may not necessarily be arm's length because we're related in some way. But if you have a transaction with Target or you have a transaction with a bank, that's an arm's length transaction, and you can be certain that that measurement of that transaction can be verified. Historical cost is how much did you pay for it when you bought it in US dollars. Simple as that. Revenue is going to be what you earned. So if you're talking about you and me, non-business people right now, when we go to work, the money that we earn for our jobs is revenue to us. The same is true for a business. Revenue that it generates from a sale is revenue. We want to recognize the revenue when it's earned, not necessarily when the cash is exchanged. When you deliver a good to a customer, that's when you've earned the revenue. That means that the customer may take 30 days to pay it to you, pay you for what they've purchased from you. But the revenue recognition principle requires us to record it immediately when we earn it, not when the money is exchanged. Expenses are used to generate revenues. You have to pay to earn money. You have to actually spend money to earn money. That's basically the principle here. So expenses are used to generate revenue. We want to recognize that expense when you have incurred it, when you receive the benefit of it. So the recognition principle for expenses is going to be matching it. We want to match our expenses with the revenue it generates. That means the timing of it is important. Always dealing with a timing issue, the same period that is revenues being recognized or being earned. The accounting equation is so important because it really does help you kind of understand how these particular transactions affect one another, and they're all interrelated. And it's important to see the relationship. So assets are going to be what you own and you can use, that you can control. Liabilities are going to be obligations to other parties. Debts, accounts payable, notes payable, salaries payable, wages payable. Equity are going to be the owner. It's going to be the residual, what's left over, what they own and what they can use are the rights of the owners of that company is the residual. So for a partnership, it's going to be called owner's equity. For a sole proprietorship, it's going to be called owner's equity. But for corporations, it's going to be called stockholders' equity. Different terms basically mean the same thing. And understand what that means and how to apply these terms when you're actually preparing balance sheet or income statement. The accounting equation assumes assets will equal liabilities plus owner's equity. This is very, very important equation, and you're going to see it quite a bit, particularly in the first 2 to 3 chapters. You're going to see that. Liabilities are going to be shown because creditors are going to always have the first rights to the assets of the organization. Economic event. And it's basically a transaction. An economic event is a transaction. What has occurred? There is a transaction that has happened. Maybe there's a sale. Maybe there's a purchase. But that transaction has to be stated in terms of this accounting equation. And we're going to go through so many different types of transactions that you're going to really start to see how these how the accounting equation is actually very helpful in analyzing the impact it has on an organization. For corporations, the common stock is going to be their ownership. Liabilities, sometimes for purchasing for operational purchases and you don't pay it right away, that's going to be more accounts payable. When you pay for items or supplies that you are going to be using in the future, that's generally going to be a prepaid, and that's an asset to you until you actually use it. Business earns money for goods and services, that's generally going to be revenue. And using these terms, it really does help you understand how to analyze transactions, which you'll see quite a number of throughout this course. So revenue from sales is going to be, it's going to be sales revenue. And what I want you to see through all of this really is how to properly identify the specific account relevant to a transaction that you're trying to record. So this slide is going to be very helpful using terms like rent. When you have to when you're in your office and you have to pay rent, that's going to be a rent expense. But if you're owner of a building and you have different tenants, that's going to be revenue to you. So understanding exactly what the transactions are gives you some really good hints as to the accounts that are affected by the various transactions. And here are many, many terms. And again, more terms that you'll need to understand. I certainly believe the more transactions that you record and the more of your homework that you're actually working on, these terms are going to make more sense to you. Practice is quite important in this course. Practice doing your homework, reading over it, understanding the terms, going back in your textbook and rereading what the terms mean and making certain that they apply to a transaction that you're trying to record really is helpful. Stockholders' equity is going to be common stock or retained earnings, and retained earnings is what's kept. It's really what's kept. They retain it. They don't distribute that out through dividends, etc. And here are the types of financial statements that you will be working on. Income statement, retained earnings, balance sheet, and statement of cash flows. And again, income statement is going to tell you how much money you've earned from your profit, and or whether you have lost. Retained earnings is going to be what's left over. Remember, the statements that you're going to prepare are going to be in the following order. You're going to prepare your income statement first. You're going to prepare your earnings statement second, and then you will prepare your balance sheet in that order. Because it's very important to note that the income statement is going to drive what's going to happen to your equity, and your equity is going to drive your balance sheet. And again, a balance sheet is going to be as of a certain point in time. So it's important to get familiar with what these particular statements look like and the information that's on each one. It really does make a difference. Statement of cash flows is going to be how you spend money, cash. Your inflows and your outflows of cash. It's only concerned with cash, and it has 3 sections that you can see here. We will be working on quite a number of these types of transactions, and you're going to see some of them have a cash effect. Some of them do not have a cash effect. And you need to know which transactions will show on statement of cash flows and which will not. Again, understanding the different types of the different sections of the statement of cash flows and what items go into each one is important. Just let's note that these are one of 4 different types of financial statements that provide different types of information to users. Analysis, again, ratios are very important because most people look at the financial statements and come, well, what does that mean? I don't understand it. Well, using ratios can allow you to be able to compare different organizations and also evaluate different areas of the balance sheet to see how your organization is doing. A ratio is going to be, there are so many. You have profitability ratios, you have equity ratios, you have liquidity ratios, etc. And depending on which ratios that you need to answer various questions or to resolve a different issue or to compare will be the ratio that you use. I thank you very much for listening, and I'm hopeful that this chapter review helpful to you.